Imagine you're standing at the top of a snowy hill, holding a tiny snowball in your hands. You place it on the ground and give it a gentle push. At first, it barely grows. It rolls slowly, collecting just a thin layer of snow. But as it keeps moving, something incredible happens. It picks up more and more snow, gaining size, weight, and momentum. By the time it reaches the bottom of the hill, it's massive, far bigger than when it started. Now imagine if you stopped that snowball halfway down the hill. Imagine if, right when it started getting big, you picked it up, threw it away, and started over with a new one. This is what most investors do with their money. They interrupt compounding before it can do its magic. This is the power of compounding, the same force that turned Warren Buffett from a young investor with a few $100s into one of the richest men in history. But here's the thing. Compounding isn't just about money. It's about decisions, time, and patience. And most people fail to take advantage of it because they don't have the discipline to let it work for them. Let's go back to 1965, when Warren Buffett took control of a struggling textile company called Berkshire Hathaway. At the time, Berkshire was a dying business. Its mills were outdated and it was losing money. Most investors would have walked away. But Buffett saw an opportunity, not in textiles, but in using Berkshire as an investment vehicle. Instead of trying to fix a bad business, he started using its cash flow to buy great businesses and hold them forever. This is where Buffett's genius really shines. Not in just picking good investments, but in understanding that time is the ultimate multiplier. One of his first big moves was investing in American Express. At the time, American Express had just gone through a scandal, one that sent its stock price plummeting. Most investors panicked and sold their shares, but Buffett understood something they didn't. He saw that American Express still had a strong brand and millions of loyal customers who trusted the company. So, while others ran away, Buffett poured millions into American Express and then did nothing. Over time, American Express recovered, expanded, and became one of the most valuable financial companies in the world. Buffett's investment turned into billions. Then came Coca Cola. In the late 1980s, Buffett recognized that Coca Cola wasn't just a soft drink. It was a global brand with an unbeatable market presence. Instead of trying to predict short-term price movements, he bought $1 billion worth of Coca Cola stock and held it for decades. And the result? Today, Buffett's stake in Coca Cola generates hundreds of millions of dollars in dividends every year, on top of the stock's massive appreciation. A $1,000 investment in Coca Cola at the time would be worth over $1.5 million today, simply by holding on to it. But Buffett isn't the only one who mastered the magic of compounding. Let's talk about Mohnish Pabrai, one of Buffett's most devoted followers. In 2012, Pabrai came across a Turkish logistics company called richest. On paper, the company was worth far more than the stock market was valuing it. Its assets, real estate, trucks, warehouses, were significantly undervalued. It was making strong profits, but nobody was paying attention. So what did Pabrai do? He bought in and waited. He didn't chase the stock price. He didn't sell when it went up slightly. He simply let the company grow, reinvest, and compound. A few years later, as the market started realizing the true value of richest, Pabrai's investment had grown over 8 times in value, and he had done nothing except hold on to a great business. Now let's look at another investor, Nick Sleep. Sleep ran a fund called Nomad Investment Partners, and his approach was simple. Find great businesses, invest heavily, and never sell. In the early 2000s, he recognized something most people ignored. Amazon wasn't just a bookstore. It was a company that was constantly reinvesting its earnings to expand its empire. While others doubted Amazon's ability to turn a profit, Sleep understood that growth takes time. He invested millions into Amazon and held on. The result? His fund grew at an astonishing 20% plus annual rate, and by the time he retired, he had turned a few million into hundreds of millions, all because he let compounding do its job. And then there's Charlie Munger, Buffett's right-hand man. Munger's story is different, but the lesson is the same. Before partnering with Buffett, Munger was an independent investor. One of his early successes was Blue Chip Stamps, a company that sold trading stamps to retailers. Munger recognized that Blue Chip's cash flow could be reinvested into better businesses, so he loaded up on shares. Over time, The value of blue-chip stamps multiplied, allowing Munger to take those profits and invest in even bigger winners like See's Candies and the Washington Post. He wasn't chasing the hottest stocks. He was letting compounding work in his favor. Let's go back even further in time, before Buffett, before Munger. One of the greatest examples of compounding comes from a man named Philip Fisher. Fisher, a legendary investor, built his fortune by buying only the highest quality businesses and holding them for a lifetime. One of his most famous investments was Texas Instruments, a company he bought in the early days of the semiconductor industry. Fisher didn't chase quick profits. He let the company innovate, expand, and dominate its industry. Over the years, his investment compounded into a fortune, proving that owning great businesses for the long term always beats short-term speculation. Another incredible case of compounding comes from Peter Lynch, the legendary manager of the Magellan Fund. Lynch's strategy was simple: find growing businesses before everyone else, invest in them, and hold on. One of his greatest investments was Dunkin' Donuts, a small coffee chain that eventually became a worldwide brand. The key takeaway? Lynch didn't make his fortune by buying and selling constantly. He made it by letting great companies grow over decades. Now here's the biggest mistake most investors make. They interrupt compounding. They panic when the stock market drops. They sell when prices go up slightly. They jump from stock to stock looking for quick gains. But the real money isn't made by trading. It's made by sitting on great businesses and letting time do the heavy lifting. Buffett himself says, "The stock market is a device for transferring money from the impatient to the patient." The reason most people never build true wealth is because they think too short-term. They want results in weeks or months, when real wealth is built over decades. So how do you apply this to your own investing? Find great businesses, companies with strong brands, loyal customers, and high returns on capital. Hold them forever. Don't sell just because the price moves up or down. Let compounding do its work. Stay patient. The market rewards those who think long-term. The next time you're tempted to sell, remember Buffett, Pabrai, Sleep, Munger, Fisher, and Lynch. They didn't get rich by chasing trends. They got rich by owning great companies and doing nothing. Because in the end, wealth isn't about how much you trade. It's about how long you hold. And if you can master this one habit, you're already ahead of 99% of investors.